Hello and thank you for watching. In this presentation, I value Polaris Incorporated. First off, Polaris is a leading powersports manufacturer for off-road vehicles, snowmobiles, motorcycles, and boats. I'll value the company two independent ways, a discounted cash flow model and a comparable company's analysis, and then reconcile both against where the stock actually trades to judge whether it is over or undervalued. For some context on the business, Polaris is a powersports company with the fiscal 2025 sales about $7.1 billion, but 2025 was a trough year. EBITDA was only $244 million, operating income was slightly negative, and the company posted a net loss of roughly $466 million on about 56.5 million shares outstanding. That depressed earnings picture matters a great deal because it is going to break some of our valuation multiples later in the analysis. The central investment question is whether today's market price assumes affordability. This offers an intrinsic value of about $54.71 per share at a price of $63. I get different sides to my midpoint, so Polaris looks fairly to modestly overvalued. The two terminal value methods at market, the conservative Gordon growth model, which gives about $45 with an 8 times EBITDA exit multiple of about $64. Essentially, what's today. Relative valuation, same story. Polaris trades price to book premium versus its peers. My recommendation is to hold with a mildly negative tilt because the recovery is already priced in. These are the operating drivers in the forecast 2026 through 2030. Start with revenue. We step growth up from 2% in 2026 to a 5% peak as the powersports cycle recovers, then ease back to 3% by 2030. A normalization, not a boom. Margins rebuild off the depressed fiscal year 2025 base, keeping climb 5% on better volume and mix. The assumption I most wanted is CapEx held at 3.3 to 3.6% of sales. That tracks Polaris's historical maintenance plus capacity spend, and importantly, it roughly matches depreciation, so net PP&E stays flat, which you'll see on the next slide. Working capital is steady, receivables at 12 days, payables at 45, with inventory days easing modestly from 95 to 90 on tighter discipline. None of these assumptions are heroic, each ties to the company's own operating history. This is asset side deep dive the assignment asks for. Two line items drive the asset base, property, plant, equipment, and inventory. As we look at net PP&E, it's essentially flat across the whole forecast, around $1.13 to $1.15 billion. That's deliberate, and it follows direct from CapEx assumption. Gross PP&E keeps rising as the company invests roughly 3.4% of sales each year. Depreciation rises almost in lockstep, so the net figure barely moves. In other words, the company is reinvesting just enough to maintain its capacity, not to expand the asset base aggressively. Inventory grows monthly from about 1.46 to 1.57 billion, tracking the sales recovery but held in check by the improving inventory days assumption. The takeaway for valuation, the asset side is stable and predictable, so it isn't where the surprises live. That's the working capital and the discount rate, which will come to. Now the liability side, the story here is deleveraging. Total debt falls from about $1.61 billion in 2026 to roughly $527 million by 2030. And interest expense drops alongside it from about $125 to $90 million. But notice the highlighted row here in 2028. Short-term debt spikes to $945 million as a tranche of long-term borrowing comes due and reclassifies to current. That's the maturity wall, and it's the single most important thing to flag on the financing side. The company has a concentrating refinancing need in 2028. If credit conditions are tight that year, refinancing cost or availability becomes a real risk to the cash flows. In the base case, we assume it refinances smoothly and the deleveraging path continues. So the liability side adds a specific datable risk, the 2028 wall, that a reader should keep in mind when judging how much cushion is in our valuation. Here's how we get the cost of equity using the CAPM model. The formula is on the screen. Required return on equity equals the risk-free rate plus beta times the equity risk premium. A risk-free rate is 4.39%, the 10-year treasury yield. The equity risk premium is 5.6%. Judgment call is beta. Regression beta is 1.51, but that regression explains only about 5% of the variation. The R squared is low, so it's easy. Other than announcing a noisy number, we use relegation mean data to state approximately. We plug this in, we get peak, which is higher, and as it should be, Polaris is typical discretionary spending business, so investors demand a meaningful premium. This 14% feeds directly into the WACC on the next slide. But a quick word on why beta matters and why we made a judgment call here. Beta drives the cost of equity at Polaris' own regression is noisy at 1.51, but with an R squared of only about 35% and a wide confidence interval running from 1.14 to 1.89. The rolling chart shows why beta spiked toward 2.25 during the COVID shock and has since settled around 1.5, so any single point estimate is sensitive to the window you pick. Yahoo reports even lower 1.26. Rather than an anchor on one unstable number, we adopted the re-leveled industry median beta of 1.72 as more stable proxy for systematic risk. It's the more conservative choice. A higher beta means a higher discount rate and a lower valuation, so it doesn't flatter our overvalued conclusion. That's exactly the kind of defensible assumption you'd lean on harder when valuing a private firm with no market beta at all. Here we bring the two costs of capital together. On the equity side, the CAPM gave us 14%, and equity is about 69% of the capital structure at market value, roughly $3.6 billion. On the debt side, Polaris' pre-tax cost of debt is 7.6% after the 21% tax shield. That's an effective 6% on about $1.6 billion of debt, or 31% of the structure. Weight each of its share, and you get a weighted average cost of capital of 11.5%. That's going to be the discount rate doing all the heavy lifting in the DCF. Every dollar of future free cash flow is discounted back at this rate. As we notice the asymmetry, equity is more than twice as expensive as debt, so the firm's reliance on equity funding is what keeps the blended rate high. This is the RWAC we carry onto the valuation on the next slide. So this is the heart of the analysis. The chart shows the unlevered free cash flow by year and its present value. Notice 2026 is slightly negative. The margin recovery hasn't yet outrun the working capital and capex needs, but cash flow turns sharply positive and builds roughly $470 million by 2030. Discounting those 5 years at our 11.5% WACC gives a present value of explicit cash flows of about $933 million. Then we have the terminal value, and this is where the two methods diverge. The growing perpetuity approach at a 2.5% long-run growth rate produces a 44.90 per share. The 8 times EBITDA exit multiple produces 64.52. We report the average 54.71 as the base case against today's market price of 63.25. That says Polaris is modestly overvalued. The stock is already priced near the optimistic end of our own range. And here I want to answer the question directly. What growth rate is implicit in the terminal value we calculated with the EBITDA multiple? The two methods I have to be internally consistent, so I set them equal. The 8 times EBITDA exit is a 2030 terminal value of about $7.23 billion. The growing perpetuity formula, run backwards, tells us what constant growth rate would reproduce that same figure given our 11.5% discount rate. The answer is 5.24%. That's the key insight. An 8 times exit multiple is not a neutral assumption. It embeds a long-run growth rate of over 5%, far above the 2.5% we think is defensible for a mature power sports manufacturer and a well above long-run GDP. The other 5% perpetuity growth only implies about 5.9 times exit multiple. So the gap between our 44.9 and 64.52 valuations is really a single disagreement about terminal growth. And the market is sliding with an optimistic end. The tornado chart here ranks our assumptions by how much they move the per share value. The single biggest swing factor is inventory days, DIO, at roughly $5.17 per share. That makes intuitive sense for power sports. This is a business that has no stock dealers with expensive, slow-moving units, so a few days of inventory ties up real cash. Payables are next about $2.45. The discount rate and terminal growth pair taken together move the value across the widest band of all, from about $27 at 13% whack with 1% growth, up nearly $80 at 10% whack with 4% growth. The practical takeaway here is that this valuation lives and dies on working capital discipline and that the discount rate versus growth assumption, not on headline revenue growth, which actually has a comparatively muted effect. That tells you where to focus diligence. Our second valuation method is relative valuation against a peer set. The football field chart shows the range of values implied by different multiples. The first thing to flag is what we can't use because fiscal year 2025 earnings and EBITDA are depressed, negative for how much of the peer group. The price to earnings ratio and EV to EBITDA multiples turn negative and become meaningless. So we lean on the two multiples that still work, EV to sales and price to book. The EV to sales, Polaris at about 1.05 times, is essentially in line with the 1.04 peer average. But on the price to book, Polaris trades at 4.26 times versus a peer average of about 1.51, a steep premium. A premium book multiple is only justified if a company earns a superior returns on that book. And right now, Polaris' depressed earnings don't support it. So the comp tells the same story as the DCF. The stock is priced highly relative to what the fundamentals currently deliver. To bring it together, two independent approaches point in the same direction. The DCF averages 54.71 per share, and the relative valuation work shows a price to book premium the fundamentals don't support, both below today's 63.25 market price. The only way our DCF reaches the market price is through the aggressive 8 times exit multiple, which we showed embeds an implausible 5.24% perpetuity growth rate. The sensitivity work reminds us the value hinges on working capital discipline and on the discount rate versus growth pair, not on revenue growth alone. So our recommendation is that Polaris is fairly to modestly overvalued. A hold with a mildly negative bias is the right move here. The recovery is largely priced in and downside protection is thin. And to close on that assignment's broader point, here we've had a public price to check against and has confirmed our model is sound. The real value of this framework is that it lets you put a defensible number on a private business where there's no market price to exist to lean on. Thank you for listening.